In 1630, the global balance of power rested on a deceptive paradox. On the surface, the Iberian Union, the massive unification of the Spanish and Portuguese crowns, represented the most formidable military machine on the planet. Its power was visible, armored, and stationary. It was anchored by the tercios, the legendary infantry that dominated European battlefields, and protected by a sprawling network of coastal stone fortresses stretching from the Tagus to the shores of Brazil. This was the wealth of the Old World: land, titles, and bullion, all locked within a rigid feudal bureaucracy that funneled every ounce of colonial profit into the insatiable war chest of King Philip IV. But while the Spanish Habsburgs focused on territorial conquest and religious homogeneity, a different kind of power was quietly decoupling itself from the earth. In the shadow of this imperial monolith, the Sephardic financial elite in Amsterdam were perfecting a new science of liquid capital. These were the descendants of those expelled from the Iberian Peninsula in 1492 and 1497, families who had transformed their physical dispossession into a strategic advantage. Because they were denied the right to own land in most of Europe, they had pivoted entirely to mobile assets, bills of exchange, maritime insurance, and commodity futures. By the early 17th century, this Sephardic network functioned as a decentralized, borderless central bank. Unlike the Spanish crown, which relied on the slow arrival of silver fleets, the Amsterdam merchants could move vast sums of wealth across borders instantly using private ledgers and family-based credit swaps. It was a classic zero-sum game. The Iberian Empire possessed the world's most valuable physical resources, but the Jewish financiers in the Dutch Republic possessed the liquidity required to operationalize them. In 1630, these two worlds were about to collide in a transaction that would change the map of the Americas. The invisible architects of finance were finally ready to fund the visible machinery of war. The Dutch West India Company's campaign to seize northern Brazil had evolved into the most expensive corporate undertaking in history. This was not a standard state-run military expedition, but a leveraged hostile takeover executed by a private, joint stock entity. In modern terms, the capital required to mobilize the fleet and sustain the occupation exceeded $50 billion. The Sephardic financiers in Amsterdam were the primary underwriters of this risk, viewing the Portuguese capitanias not as territory to be governed, but as distressed assets to be seized and liquidated for their high-yield sugar production. The financial structure of the invasion was built on extreme leverage. The WIC operated as a 17th-century private equity firm, raising massive capital from private shareholders to fund a burn rate that would bankrupt any traditional monarchy. While the Spanish crown relied on stagnant tax revenues, the Amsterdam merchants used the secondary market of the Bourse to keep the invasion liquid. They were essentially betting on a turnaround play. Invest heavily in naval hardware today to capture the global sugar supply chain tomorrow. The stakes were binary. A failed invasion meant the total evaporation of Sephardic capital and the strengthening of the Inquisition's fiscal grip. Success, however, promised a total monopoly on the world's most valuable consumer commodity. These investors calculated the cost-to-benefit ratio with cold precision, factoring in ship depreciation, soldier salaries, and the projected price of sugar per chest. In the high-stakes world of 1630, the Brazilian invasion was the ultimate long position on Dutch maritime power and a short on the stability of the Iberian Empire. It was the culmination of a decade of intensive lobbyings and logistical planning by a sophisticated cadre of Sephardic exiles. These individuals were not merely passive investors. They functioned as the strategic architects of the West India Company's Atlantic policy. Having been the primary administrators of the Portuguese sugar trade for generations, these refugees possessed proprietary data on the specific yields, mill locations, and shipping bottlenecks of the Pernambuco region. They converted this specialized knowledge into a persuasive business case for the Dutch States General, transforming a vague geopolitical rivalry into a precision-engineered military objective. The Jewish merchants in Amsterdam held the software to the Portuguese Empire's hardware. While the Dutch military provided the ships, the Sephardic elite provided the necessary commercial infrastructure, including established contacts within the new Christian merchant class still residing in Brazil. This allowed the WIC to bypass the typical learning curve of colonial administration. These financiers drafted the economic bylaws of the new colony, ensuring that the legal framework of Dutch Brazil favored merchant liquidity over traditional landholding models. By mapping the exact fiscal weaknesses of the Iberian Union, these architects identified Brazil as a distressed asset that could be detached from the Spanish crown with minimal structural damage to the production facilities. They utilized their family-based intelligence networks to track the movement of Portuguese silver and the timing of the harvest cycles, ensuring the invasion fleet arrived at the moment of maximum economic vulnerability. In essence, the Sephardic elite provided the intellectual capital that allowed a fledgling Dutch company to outmaneuver a centuries-old global superpower. The Inquisition in the 17th century functioned less as a purely religious tribunal and more as a sophisticated mechanism for state-sponsored asset forfeiture. For the Spanish crown, facing chronic insolvency due to the staggering costs of the 30 Years' War, the auto da fe served as a critical fiscal tool to bridge massive budget deficits. Under the legal framework of the time, a conviction for Judaizing triggered the immediate and total confiscation of the accused's entire estate. This was not a secondary penalty, but a primary economic objective, targeting the liquid capital, real estate, and international credit lines held by the wealthy Sephardic merchant class. The efficiency of this system relied on a predatory denunciation economy. The Inquisition offered financial incentives to informants, creating a self-sustaining cycle of litigation that systematically liquidated Jewish-owned businesses. Once an individual was arrested, their assets were frozen and managed by royal administrators, ensuring that even if the accused was later cleared, the administrative costs often consumed the bulk of the wealth. This capital was immediately redirected to the asientos, the short-term, high-interest loans provided by Genoese and German bankers to fund the Spanish infantry. The Inquisition tax had become an indispensable revenue stream for King Philip IV, effectively cannibalizing the most productive sector of the Iberian economy to sustain a failing military hegemony. This persistent threat of expropriation fundamentally altered the risk profile of Sephardic capital. Money that was unsafe in Lisbon or Madrid became the seed capital for the Dutch West India Company. The invasion of Brazil, therefore, was a direct offensive response to this fiscal aggression. The Jewish financiers were not just seeking a new market, but were actively moving their capital out of a jurisdiction where heresy was a legal pretext for state-mandated bankruptcy. In the 17th century, sugar was the undisputed driver of global trade, functioning as a high-velocity commodity with a market profile nearly identical to modern crude oil. It was the white gold of the Atlantic, a non-essential luxury that had rapidly transitioned into a global necessity, creating an inelastic demand curve across every European capital. In 1630, Brazil was the world's largest producer, accounting for over 80% of the refined sugar reaching the Amsterdam market. For the Sephardic merchant elite, this was not just a foodstuff, it was a standardized financial asset that provided the primary collateral for international credit markets. The profitability of sugar was rooted in its unique role as a portable, shelf-stable store of value. Unlike perishable grain, sugar could be warehoused for years, allowing traders to manipulate supply and wait for peak price windows. This made it the perfect instrument for commodity futures and speculative hedging. The Sephardic families in the Dutch Republic controlled the crucial midstream processing and distribution networks, but they were vulnerable to the Portuguese monopoly on the raw extraction. The aggression of 1630 was, at its core, a strategic move to capture this entire supply chain. By seizing the Engenhos of Pernambuco, the Dutch West India Company aimed to bypass the Iberian middlemen and establish a direct well-to-consumer pipeline. Because sugar prices remained high, even during periods of extreme European inflation, it provided a reliable hedge against currency devaluation. For the Jewish financiers, controlling Brazil meant controlling the primary source of the world's liquidity, turning the humid plains of the Northeast into a 17th century refinery that pumped constant, reliable wealth into the Dutch banking system. The Amsterdam Sephardic elite identified a critical structural inefficiency in the global sugar trade, the disconnect between processing power and raw material ownership. For decades, Jewish financiers had dominated the downstream sector, operating the high-margin refineries in the Dutch Republic that transformed brown muscovado into the white loaves sold across Europe. However, they remained strategically vulnerable to the Portuguese monopoly on the upstream production. The realization took hold that while refining was profitable, the true engine of wealth was the Engenho, the Brazilian sugar mill that combined land, specialized equipment, and forced labor into a singular, high-output industrial unit. Vertical integration became the primary objective of the 1630 invasion. The financiers recognized that as long as the Portuguese controlled the planting and initial crushing, the Amsterdam merchants were merely service providers, subject to Iberian price manipulation and supply shocks. By seizing the captaincies of Pernambuco, the investors aimed to internalize the entire supply chain. This move would allow them to capture the producer surplus, currently being siphoned off by the Portuguese crown and local mill owners. The financial logic was cold and precise. Controlling the upstream meant controlling the pace of the global market. The Sephardic elite intended to apply Dutch maritime efficiency to the feudal Brazilian landscape, transforming disorganized agricultural tracts into a streamlined corporate extraction zone. This shift from being mere middlemen to becoming owners of the source represented a fundamental change in Sephardic economic strategy. It moved their capital from the safety of European ports directly into the heart of the colonial machinery, a betting that the increased margins of a vertically integrated empire would justify the immense physical risks of the Atlantic crossing. In 1630, the strategic objective of the Amsterdam Sephardim transcended mere profit. It was a search for territorial sovereignty that would decouple their fate from European state politics. For the Jewish merchant elite, the Dutch West India Company provided a unique legal vehicle to achieve what was essentially a Zion in the tropics. This ambition mirrored the later strategy of the Sassoon dynasty, who moved their operations from Baghdad to Bombay to escape Ottoman instability. In the 17th century context, the Jewish financiers in Amsterdam were seeking a permanent refuge where the Judaizing laws of the Iberian Union could no longer reach their families or their capital. The establishment of the Dutch colony in Brazil represented the first modern attempt to create a self-governing Jewish civil society backed by a colonial military. The financiers negotiated specific guarantees within the WIC Charter that ensured religious freedom and the right to own landed property, rights systematically denied to them in almost every other jurisdiction. This was not a sentimental pursuit, but a cold calculation of risk management. By funding the capture of Pernambuco, the Sephardim were effectively buying an insurance policy against the shifting alliances of European monarchs. The result was a revolutionary administrative shift. In Recife, the Sephardic community operated with a level of autonomy that predated the Enlightenment, managing their own communal taxes, legal disputes, and educational institutions. This enclave served as a hub for a global network of new Christian merchants who were looking for a safe harbor to revert to their ancestral faith without the threat of the Inquisition. The Dutch West India Company, or WIC, chartered in 1621, represented a radical departure from traditional state-sponsored exploration. It was essentially the world's first private equity war machine, a corporate entity endowed with sovereign powers to wage war, negotiate treaties, and administer justice across the Atlantic. Unlike the Dutch East India Company, which focused on trade routes, the WIC was specifically engineered for aggressive territorial expansion and the destruction of the Spanish-Portuguese monopoly. Its capital structure was its greatest weapon, By issuing public shares, the company decoupled the costs of war from the national treasury, allowing it to tap into the massive liquidity of the Amsterdam merchant elite. This corporate structure transformed warfare into a scalable business model. The WIC functioned as a high-risk, high-reward investment vehicle, where the product was the capture of enemy assets and the dividends were derived from the systematic extraction of colonial resources. The company's board, the Heeren 19th, operated like a modern board of directors, making strategic military decisions based on fiscal projections and shareholder pressure rather than dynastic honor. For the Sephardic financiers, the WIC offered a level of legal protection and professional management that individual ventures lacked. By pooling their capital into this corporate shell, they could fund a level of naval hardware and mercenary manpower that was previously the sole domain of monarchs. The WIC didn't just seek to trade with Brazil, it sought to own it. It was a precision-tooled instrument of Dutch mercantilism, designed to turn the volatile Atlantic into a predictable revenue stream through the sheer force of private sector militarism. In 1630, the strategic blueprint for the Brazilian operation was not a work of military theory, but a carbon copy of the Dutch East India Company's VOC successful spice trade model. For the Sephardic financiers, the VOC provided the necessary data-driven proof of concept that a private corporation could effectively outgovern a traditional empire by prioritizing logistics over landholding. By analyzing 20 years of VOC balance sheets, the Amsterdam merchant elite recognized that the key to colonial domination lay in the factory system, a network of armed, fortified trade hubs, rather than broad, expensive territorial control. The financial architecture of the Brazilian invasion was built on the VOC's pioneering use of permanent capital. Unlike previous one-off voyages where investors liquidated their positions after each return, the VOC model utilized an indefinite investment horizon. This allowed the West India Company to build long-term naval infrastructure that did not rely on immediate harvest results. The Sephardic investors applied this evergreen funding strategy to the Atlantic, ensuring that the fleet could maintain a constant presence in the South Atlantic to disrupt Portuguese shipping. This was 17th century big data. The financiers used VOC harvest records and shipping manifests to calculate the exact price elasticity of global commodities. They understood that if they could replicate the VOC's monopoly on Indonesian cloves with Brazilian sugar, they could dictate global interest rates. The VOC had proven that a merchant board of directors could manage an overseas army more efficiently than a king's court. In 1630, the WIC was simply the VOC's logic applied to a different hemisphere, a battle-tested, profitable algorithm for conquest that the Jewish elite were eager to fund. In 1630, the financial architecture of the Brazilian invasion relied on a revolutionary concept, fractional ownership through the joint stock model. Unlike the Spanish or Portuguese empires, our military ventures were funded by the royal purse or high-interest loans from a handful of Genoese banking houses, the Dutch West India Company, WIC, democratized the cost of war. By breaking the massive capital requirement of the invasion into thousands of individual shares, the company allowed a broad spectrum of investors, ranging from wealthy Sephardic merchants to middle-class artisans, to fund an armada that exceeded the fiscal capacity of any single European monarch. This dispersed ownership created a resilient, bottom-up military fund. For the Sephardic financiers, this instrument was a tool of extreme capital efficiency. It allowed them to maintain a diversified portfolio, spreading their risk across multiple ships and colonial sectors rather than betting their entire net worth on a single voyage. This system effectively turned the Jewish community into a collective venture capital fund, providing the WIC with a constant stream of liquid, dry powder that could be called upon to replace lost vessels or hire mercenary reinforcements. Crucially, the joint stock model separated the ownership of the war from the management of the war. While thousands held shares, the tactical decisions were concentrated in a professional board, ensuring that the invasion was run with the cold efficiency of a business operation rather than the ego-driven whims of a king. By 1630, fractional ownership had turned the Atlantic into a marketplace for military aggression, where the Sephardic elite used their superior liquidity to outfund the Iberian crown. In 1630, the Dutch West India Company's tactical advantage was rooted in an information asymmetry that modern analysts would categorize as systemic insider trading. The Sephardic community in Amsterdam maintained a seamless, clandestine intelligence loop with the new Christian merchant class. Conversos, who had remained in Brazil after the Iberian Union's takeover, these individuals acted as embedded analysts, providing the WIC with real-time due diligence reports that were far more accurate than the official dispatches received by the Spanish crown in Madrid. Through private correspondence, encoded in Hebrew or Ladino, they bypassed traditional censors to deliver granular data on the specific vulnerabilities of the Portuguese defense. These intelligence reports prioritized hard economic and military metrics over narrative updates. The Amsterdam financiers received precise inventories of the sugar stocks sitting in the warehouses of Recife and Olinda, allowing them to calculate the exact liquidation value of the territory before the first shot was fired. More critically, the reports provided a detailed breakdown of Portuguese troop morale and the critical shortage of gunpowder and naval supplies within the local garrisons. This proprietary data allowed the WIC to time the invasion with surgical precision, striking when the Iberian supply chain was at its weakest. The Sephardic network functioned as a decentralized human signal platform, turning family ties into a high-security communications infrastructure. While the Portuguese military relied on outdated maps and slow-moving bureaucrats, the Jewish financiers were trading on live information. But in the high-stakes world of 1630, this wasn't just espionage. It was the application of superior information technology to ensure that the capital invested in the invasion was backed by a guaranteed military outcome. The Dutch West India Company's offensive was sustained by a legal and financial innovation that effectively commodified naval combat: the Letter of Marque. This document was a state-issued license that authorized private vessels to commit acts of piracy against the Spanish and Portuguese crowns under the legal umbrella of the Dutch Republic. For the Sephardic financiers, this instrument transformed the high risks of Atlantic warfare into a predictable, dividend-paying asset class. Unlike a state-run navy, where the spoils of war were absorbed by the sovereign treasury, the WIC's letters of marque ensured that every captured merchantman and every chest of confiscated silver was liquidated and distributed as a corporate profit to the company's shareholders. This financialization of maritime violence allowed the WIC to operate as a self-funding military entity. The Sephardic elite provided the capital to outfit these privateers, essentially treating a warship as a mobile piece of industrial equipment designed for high-yield asset seizure. Each expedition was backed by a precise legal contract detailing the prize money splits between the crew, the company, and the investors. State-sponsored piracy had become the primary revenue driver for the Brazilian invasion. The Dutch weren't just disrupting Portuguese trade, they were harvesting it. For the Jewish financiers, the Letter of Marque functioned as a 17th-century hedge instrument. If the sugar harvests failed or a land siege stalled, the liquid profits from captured Iberian galleons provided the necessary cash flow to keep the company solvent. This system turned the South Atlantic into a predatory marketplace, where the Sephardic elite leveraged the legality of piracy to ensure a constant return on their military investment. In 1630, the Amsterdam Bourse functioned as the world's most sensitive economic barometer, turning the speculative Plan for Brazil into a high-volatility financial instrument. While the West India Company attempted to maintain operational security, the sheer scale of the capital call made total secrecy impossible. The Sephardic merchant elite, interconnected through cross-border family councils, were the first to identify the signal amidst the noise of the exchange. As rumors of the 67-ship armada leaked, WX shares became the primary vehicle for speculating on the collapse of the Iberian Union, leading to wild fluctuations that modern traders would recognize as classic information leakage price action. The Bourse served as a secondary market where the intangible assets of the invasion were priced in real time. Investors weren't just trading company equity, they were trading on the probability of a successful amphibious landing. The Sephardic financiers utilized their superior information networks to engage in sophisticated hedging, buying WIC positions while simultaneously shorting Portuguese maritime insurance contracts. This created a feedback loop where the rising price of a WIC stock on the Amsterdam floor effectively signaled to the rest of Europe that the hostile takeover of Brazil was imminent. By the time the fleet departed, the Bourse had already priced in the capture of the sugar mills, leading to a massive expansion of the Dutch Republic's credit supply. The Jewish elite used this inflated share value as collateral to secure further loans, creating a pyramid of liquidity that funded the initial months of the occupation. In 1630, the Amsterdam Stock Exchange proved that a war could be won on the trading floor long before the first cannon was fired in the Atlantic. In 1630, the internal hierarchy of the West India Company, WIC, revealed a startling concentration of power within a select group of Sephardic dynasties. And while the company marketed itself as a broad-based joint stock venture, the dry powder that actually propelled the fleet toward Brazil came from 18 specific families who held massive, outsized blocks of equity. These names, including the Cohen, Enriquez, d'Andrade, and the Suasso families, represented less than 1% of the Dutch population, yet they controlled a double-digit percentage of the WIC's voting capital. This was not a passive investment, it was a concentrated, multi-generational bet on the seizure of the Atlantic sugar trade. These 18 families operated as a cohesive syndicate of interest, using their capital to secure seats on the regional chambers of the WIC. By controlling these blocks of stock, they ensured that the company's military objectives remained aligned with their private commercial networks. These shareholders were often interconnected through complex cross-border marriages and partnership agreements, creating a unified block of capital that was immune to the erratic shifts of public sentiment on the Amsterdam Bourse. Their participation provided the WIC with essential institutional stability. While smaller Christian investors might panic and sell during a naval setback, these 18 families maintained an evergreen commitment, understanding that the long-term appreciation of their Brazilian assets far outweighed short-term volatility. This concentration of ownership effectively turned the WIC into a private vessel for Sephardic ambition. By 1630, the secret of the company's resilience was clear. It wasn't just funded by the Dutch Republic, but by a tight-knit financial elite who had consolidated the world's most mobile capital into a single, lethal military objective. The strategic deployment of the Dutch West India Company's Armada represented a milestone in naval history, marking the largest maritime force ever dispatched to the Southern Hemisphere. This was not a tentative exploratory fleet, but a concentrated strike force consisting of 67 heavily armed vessels and 7,000 personnel. The scale of this mobilization was an industrial feat. The fleet carried 1,170 cannons, more firepower than the entire standing defense of the Portuguese South Atlantic colonies combined. For the Sephardic financiers, the magnitude of this hardware was the physical manifestation of their all-in investment strategy, shifting the theater of war from European coastal waters to the deep water Atlantic. The composition of the force was meticulously engineered for a specific tactical outcome: the permanent seizure of a high-yield industrial hub. Of the 7,000 men, nearly 4,000 were professional mercenary soldiers, primarily German and English veterans of the 30 Years' War, hired with a liquid capital provided by the Amsterdam merchant elite. This severed the military's dependence on Dutch national conscription, allowing the WICs to field a private army specialized in siege warfare and amphibious assault. The logistical requirements for a force of this size were unprecedented. The fleet carried enough provisions, salted meat, hardtack, and beer to sustain 7,000 men for a minimum of 9 months without landfall, ensuring the Armada could bypass traditional supply ports. This autonomy allowed the Dutch to maintain the element of surprise, striking Recife with a force that was numerically superior to any local militia. In 1630, the sheer tonnage of the W-Wick fleet signaled the arrival of a new era, the corporate-funded total war. In February 1630, the Dutch West India Company executed a tactical masterpiece that invalidated the entire Portuguese defensive architecture of Pernambuco. For years, the Portuguese had focused their limited capital on fortifying the port of Recife, installing heavy artillery batteries at Fort São Jorge to command the narrow reef channels. They operated on the conventional military assumption that any invasion force of significant tonnage would be forced to contest these deep water entries. However, the W-Wick's due diligence reports had identified a structural flaw in this logic. The long, unfortified stretch of coastline to the north, known as Pau Amarelo. Instead of engaging the heavy guns in a direct naval duel, the Dutch Admiral Lonck directed the 67-ship armada toward these northern shallows. The maneuver was a precision-engineered amphibious assault. By utilizing flat-bottomed landing craft, invested in specifically for this shallow water theater, the Dutch landed nearly 3,000 professional mercenaries on the beaches of Pau Amarelo, miles away from the Portuguese cannon range. This effectively short-circuited the Iberian defense. The Portuguese found their expensive stone fortifications facing the wrong direction. By the time the alarm reached Recife, the Dutch infantry had already established a secure beachhead and begun a rapid overland march toward Olinda. This landing proved that mobile, sea-based capital could always outmaneuver stationary, land-based defenses. The Portuguese, trapped in their fixed positions, were forced to watch as the Dutch bypassed their primary assets to strike at the administrative heart of the colony. In a single afternoon, the tactical brilliance of the Pau Amarelo landing turned the most fortified region of Brazil into a defenseless target for the WIC's corporate army. Between 1630 and 1635, the Dutch West India Company's high capital invasion devolved into a punishing war of attrition, creating a stark operational divide between maritime dominance and terrestrial paralysis. While the WIC fleet maintained an absolute blockade of the coast, effectively cutting off the Iberian Peninsula from its primary sugar supply, the Dutch mercenary army found itself besieged within the very urban centers it had captured. The Portuguese defenders, led by Matias de Albuquerque, abandoned the vulnerable stone fortifications of Recife and Olinda for the Arraial do Bom Jesus, a fortified camp deep within the hinterland. This shifted the conflict from a conventional European siege into a relentless campaign of guerra de emboscadas, or ambush warfare. This 5-year stalemate exposed the limitations of the Dutch joint stock military model. The WIC's professional soldiers, trained for open-field maneuvers in the 30 Years' War, were ill-equipped for the irregular tactics of the Luso-Brazilian militias. These local forces utilized the dense tropical vegetation as a natural defense system, launching hit-and-run strikes on Dutch supply columns and burning the very sugar mills the Amsterdam financiers had intended to seize as assets. For the Sephardic investors, this period represented a catastrophic burn rate of capital. Every month of stalemate increased the interest on the company's debt, while the expected dividends from sugar exports remained frozen in the charred fields of the interior. The Dutch controlled the global liquid trade routes, but the Portuguese controlled the solid geography of production. In 1630, the W-Wick had bought a territory, but by 1635, they realized they had only purchased a ruinous 5-year siege. In 1632, the Dutch West India Company's stalled campaign was salvaged by the defection of Domingos Fernandes Calabar, a mulatto intermediary who possessed the exact geographical software the W-Wick's mercenary army lacked. Calabar was a native of Porto Calvo with intimate knowledge of the backdoor logistical routes that sustained the Portuguese resistance at the Arraial do Bom Jesus. His decision to switch allegiances provided the Dutch with a proprietary map of the interior's hidden supply lines, effectively neutralizing the Guerra de Emboscadas that had paralyzed Dutch capital for years. This was not a change in military technology, but a massive upgrade in human intelligence that allowed the WIC to transition from defensive urban fortification to aggressive inland penetration. Calabar's intelligence functioned as a tactical multiplier. He identified the specific river fords and jungle narrow points where the Portuguese militias were most vulnerable, allowing Dutch commanders to execute surgical strikes against the Luso-Brazilian storage depots. By revealing the secret paths used to transport sugar and cattle from the hinterland to the coast, he enabled the WIC to systematically dismantle the economic base of the resistance. This intelligence led directly to the fall of the Arraial do Bom Jesus in 1635, the capture of Porto Calvo, and the eventual retreat of Portuguese forces toward Alagoas. For the Sephardic financiers, Calabar was the missing link in their investment strategy. His data allowed the company to finally secure the upstream sugar mills, turning charred assets back into productive industrial units. In the high-stakes logic of 1630, Calabar's defection represented the final successful due diligence report, providing the Dutch with the spatial certainty required to consolidate their territorial monopoly over northern Brazil. As the Dutch West India Company's military radius expanded, the Portuguese plantocracy initiated a systematic scorched earth policy designed to decouple the WIC's territorial gains from their fiscal value. This was an act of industrial sabotage on a continental scale. Recognizing that the invasion was a leveraged operation dependent on immediate cash flow, the retreating Portuguese planters chose to incinerate the engenhos, the complex sugar mills that represented the primary capital of the colony. This strategy targeted the very upstream assets the Sephardic financiers had sought to internalize, ensuring that the Dutch inherited a landscape of stranded assets rather than a functioning production machine. The destruction was not limited to the physical crushing machinery. It included the targeted slaughter of specialized livestock and the burning of the fuel wood forests required to fire the refinery boilers. For the WIC's shareholders in Amsterdam, this represented the ultimate tail risk becoming a reality. The company was forced to maintain a massive standing army of 7,000 men while the collateral for their investment was being reduced to ash. By 1635, the Dutch controlled the administrative centers, but they were presiding over a massive write-down of their Brazilian portfolio. This policy of total economic negation fundamentally altered the financial profile of the occupation. To rebuild the mills, the WIC was forced to issue new, high-interest debt, further diluting the potential for future dividends. The Sephardic elite found themselves in a sunk cost trap. They had to invest even more capital into reconstruction just to prevent the total loss of their initial $50 billion gamble. The Portuguese had successfully transformed the white gold of Brazil into a fiscal black hole, proving that territorial conquest was meaningless without the industrial infrastructure to monetize it. In 1637, the arrival of Johann Moritz van Nassau as Governor-General initiated a transition from military occupation to sophisticated urban governance. Moritz recognized that the West India Company's sunk cost in Brazil could only be redeemed by transforming Recife into a high-functioning, cosmopolitan capital. This led to the construction of Maritstad, a planned city on the island of Antonio Vaz that utilized Dutch hydraulic engineering to expand the habitable land through a network of canals and bridges. Much like the later development of colonial Shanghai, this was an attempt to build a modern, European-style infrastructure in an overseas enclave to facilitate the rapid movement of global capital. The urban design of Maritstad prioritized administrative efficiency and public health. Moritz commissioned the construction of the Great Bridge, the first major civil engineering project of its kind in the Americas, to connect the administrative center with the commercial port. This infrastructure was funded by a combination of WIC capital and local taxes, effectively turning the city into a productive asset. The city featured paved streets, a municipal drainage system, and the first botanical garden and astronomical observatory in the southern hemisphere, shifting the colony's identity from a series of embattled mills to an enlightened, globalized trade hub. For the Sephardic elite, this urban expansion provided the necessary stable environment for large-scale commerce. Moritz' policy of religious toleration was formalized in the city's legal code, allowing for the public establishment of the Kahal Zur Israel Synagogue. By professionalizing the city's bureaucracy and inviting scientists, architects, and painters, Moritz successfully converted a war-torn outpost into a premier destination for the Atlantic merchant class. This transformation proved that the Dutch experiment in Brazil was no longer a temporary raid, but a permanent, vertically integrated corporate state. By 1636, the West India Company's consolidation of Pernambuco facilitated a unique socio-legal phenomenon, the institutionalization of the first Jewish congregation in the New World, Kahal Zur Israel. For the Sephardic financiers, this was the religious dividend of their Atlantic campaign, a tangible spiritual return on a military investment that finally provided a jurisdiction safe from the Holy Office of the Inquisition. The construction of the synagogue on the Rua dos Judeus in Recife was not merely a cultural act, it was a formal declaration of permanent residency. Unlike the New Christians, who lived under the constant threat of confiscation in the Iberian Union, the Jews of Dutch Brazil operated under a charter that specifically protected their right to public worship and communal self-governance. The synagogue functioned as a vital hub for the Atlantic merchant network, centralizing the legal and financial affairs of the community. It provided a structured environment for the reversion of converso merchants who arrived from across the Spanish Empire to openly reclaim their ancestral faith. The congregation was led by Rabbi Isaac Aboab de Fonseca, the first rabbi to set foot in the Americas, whose presence signaled that Recife had achieved the status of a legitimate center of Hebrew learning. This institutional stability had a direct impact on the WIC's bottom line. The synagogue provided a high-trust environment for the negotiation of complex sugar contracts and shipping manifests, using the Jewish communal court to resolve commercial disputes without relying on the slow-moving Dutch colonial bureaucracy. In 1630, the invasion was a financial gamble. By 1640, the presence of Kahal Zur Israel proved it had become a successful experiment in religious and economic sovereignty. By 1640, the Dutch West India Company's strategic consolidation of northern Brazil had achieved its primary fiscal objective, the weaponization of the global sugar market. Within a single decade of the Pau Amarelo landing, the WIC successfully brought nearly 50% of the world's refined sugar production under its direct corporate administration. This was a transition from competitive trade to a structured monopoly that allowed the Amsterdam Board of Directors to function as the primary price setters for Europe's most valuable commodity. The company utilized its naval superiority to enforce a strict, closed-loop logistics system, requiring all sugar produced in the captured captaincies to be shipped exclusively on WIC chartered vessels and processed through Dutch-controlled refineries. The economic impact of this monopoly was transformative for the Republic's credit rating. By controlling the upstream supply, the WIC could artificially manipulate market scarcity to maximize the producer surplus that had previously been captured by the Portuguese crown. This dominance was reinforced by a 1638 decree that centralized the auctioning of sugar at the Amsterdam Bourse, effectively making the Dutch Republic the clearinghouse for the global trade. For the Sephardic financiers, this 50% market share represented the ultimate validation of their vertical integration thesis. The immense volume of trade, measured in hundreds of thousands of arrobas annually, provided the necessary collateral to fund the company's increasing administrative and military overhead. By 1640, sugar had ceased to be a mere agricultural product and had become a strategic reserve, giving the WIC's shareholders unprecedented leverage over the currencies and trade balances of the European powers. By 1641, the Dutch West India Company's administration of Brazil transitioned from a purely military operation into a complex credit-based economy. With the sugar mills largely destroyed by the previous scorched earth campaigns, the Luso-Brazilian planters, who had remained under Dutch rule, faced a total lack of operating capital. The Sephardic financiers in Recife stepped into this void, functioning as the primary credit engine of the colony. These merchants provided the essential liquidity needed to rebuild the industrial crushing machinery and purchase the forced labor required to resume production. This was not traditional banking, but a high-risk lending model where loans were often secured against future harvests, effectively making the Jewish elite the senior creditors of the entire planter class. The interest rates on these private loans, often ranging from 18% to 24%, reflected the volatile nature of the Atlantic frontier. This financial middleman role allowed the Sephardic community to capture a significant portion of the colony's economic output before the sugar ever reached the Amsterdam Bourse. By 1644, the total private debt owed to Jewish lenders in Recife was estimated at millions of guilders, on a figure that exceeded the West India Company's own liquid reserves in the region. This debt trap provided the Dutch administration with a secondary layer of control over the potentially rebellious Portuguese population. However, it also created a dangerous structural imbalance. The survival of the Luso-Brazilian elite was now contingent on the liquidation of their debts. For the Sephardic financiers, this massive credit exposure turned every sugar mill in Pernambuco into a de facto subsidiary of their Amsterdam-based family firms, further concentrating the wealth of the New World within a tight-knit financial network. By the late 1630s, the Dutch West India Company identified a critical bottleneck in its Brazilian sugar monopoly: the acute shortage of industrial labor caused by the collapse of indigenous populations and the disruption of previous Portuguese supply chains. To protect their upstream investments, the Sephardic financiers orchestrated a strategic pivot into the transatlantic slave trade, transforming it into the brutal logistics arm of the colonial economy. This was a move toward horizontal diversification, where the company utilized its naval hardware to seize the primary West African embarkation points, most notably the capture of São Jorge da Mina, Elmina, in 1637, and Luanda in 1641. The financialization of this human traffic allowed the WIC to internalize the highest cost variable in sugar production. By controlling the input of labor as well as the output of refined sugar, the Amsterdam Board of Directors achieved a level of vertical integration that was previously unprecedented. Sephardic merchants in Recife acted as the primary auctioneers and distributors, utilizing their existing credit networks to sell captives to the very planters who were already indebted to them for their mill machinery. This diversification turned the South Atlantic into a closed corporate circuit. The profits from sugar were reinvested into the purchase of more vessels for the Middle Passage, creating a self-sustaining cycle of capital accumulation. By 1644, the WIC had transitioned from a sugar trading entity into a multi-sector conglomerate where the movement of people was as precisely metered and priced in as the barrels of molasses they produced. This pivot ensured that every stage of the colonial value chain generated a dividend for the company's shareholders. By 1642, the Sephardic merchant class in Dutch Brazil moved to solidify their social and economic position through the systematic acquisition of high-value urban real estate. As the Portuguese Catholic elite fled to the southern captaincies or the interior, they liquidated their primary residential and commercial assets at distressed prices. The Amsterdam-backed financiers utilized their superior liquidity to purchase these stone homes, the massive multi-story masonry structures of Recife and Olinda that had traditionally signaled aristocratic status. This was a strategic move to convert mobile trade profits into fixed capital, effectively replacing the old Iberian nobility with a new, corporate-aligned merchant aristocracy. The acquisition of these properties was not merely a matter of shelter, it was a play for administrative control. By owning the physical infrastructure of the city, the Sephardic elite gained seniority in local municipal councils and controlled the rental markets for the influx of Dutch bureaucrats and soldiers. They renovated these estates using European architectural standards, incorporating warehouses on the ground floors to integrate their domestic lives with their commercial operations. In Recife's Rua dos Judeus, this concentration of property ownership created a high-density financial district that rivaled the quarters of Amsterdam. This dominance in the real estate market functioned as a barrier to entry for competing merchant groups. By controlling the limited supply of stone-built structures within the fortified perimeter of Recife, the Jewish community secured the safest collateral in the colony. By 1645, nearly half of the primary urban residences in the capital were owned by Sephardic families. This shift from tenant to landlord represented the final stage of their colonial integration, ensuring that their influence was literally etched into the stone and mortar of the new Dutch state. By 1643, the West India Company's Brazilian enterprise entered a phase of critical overleverage, where the burn rate of the military occupation began to decouple from the actual quarterly yields of the sugar industry. The company was maintaining a standing force of nearly 6,000 professional soldiers and a constant naval presence of 40 warships, on an overhead that required over 2 million guilders annually in wages and provisions. This fixed cost did not account for the fluctuating price of sugar on the Amsterdam bourse, or the recurring capital expenditures required to repair mills damaged by the ongoing inland skirmishes. For the Sephardic financiers, the company's balance sheet began to show the symptoms of a debt trap, where the cost of defending the asset was eroding the very dividends the asset was intended to produce. The fiscal crisis was exacerbated by a decline in the company's capital utilization efficiency. To cover the shortfall, the WIC was forced to issue short-term, high-interest bonds, effectively borrowing against future harvests that had not yet been planted. This created a secondary market of debt that further diluted the value of the original shares held by the Amsterdam elite. The Sephardic community, heavily exposed to these bonds, realized that the WIC was essentially running hot, using new investment to pay off old operational debts rather than funding growth. By 1644, the WIC's debt-to-equity ratio reached a breaking point. The administrative decision to recall Johann Moritz was a desperate attempt at cost-cutting to appease shareholders who demanded immediate liquidity over long-term stability. This shift toward austerity signaled the end of the expansionary phase. The New World venture, which had begun as a high-margin monopoly, was now a fragile, leveraged operation, highly susceptible to any disruption in the Atlantic supply chain or a rise in interest rates back in the Dutch Republic. By 1645, the economic relationship between the Luso-Brazilian planters and the Sephardic merchant elite reached a point of systemic insolvency. While the Dutch West India Company's military had secured the territory, the true governance of the colony was dictated by the ledger books of the Jewish creditors in Recife. Most planters were carrying debt loads that far exceeded the annual productive capacity of their mills, with interest rates compounded by years of instability. This created a structural incentive for insurrection. The Portuguese elite realized that a successful military rebellion was not merely a nationalist uprising, but a massive non-judicial debt jubilee. By expelling the Dutch and their financiers, the planters could effectively wipe their balance sheets clean through the physical elimination of their creditors and the destruction of the legally binding loan contracts. The rebellion, known as the Pernambucan Insurrection, was thus a fiscal strategy masked by religious and patriotic rhetoric. The leaders of the revolt, many of whom were the most heavily indebted mill owners, targeted the administrative records and the notary offices where the Sephardic merchants held their liens. This was a direct assault on the Dutch capital system. The planters understood that in a 17th century legal environment, the absence of the physical document often meant the absence of the debt. For the Sephardic community, this realization turned their credit engine into a target. Their massive financial exposure to the local population became a terminal liability. As the insurrection moved from the interior toward the coast, the Portuguese didn't just burn the fields. they hunted the holders of the debt. In 1645, the financial logic of the colony inverted. The very loans that had rebuilt Brazil became the primary catalyst for its destruction, as the debtors calculated that the cost of a war was significantly lower than the cost of repayment. By 1645, the Luso-Brazilian leadership recognized that a purely fiscal argument for rebellion lacked the necessary emotional force to mobilize the non-indebted peasantry and clergy. To solve this, they rebranded the debtors' revolt as a divine war, or Guerra da Liberdade Divina, framing the expulsion of the Dutch as a holy crusade against Calvinist and Jewish heresy. This was a calculated use of ideological soft power to unify the colony's disparate social classes under a single banner of Catholic restoration. While the mill owners were primarily concerned with the erasure of their high-interest liens held by Sephardic merchants, the rhetoric presented the conflict as a struggle for the purity of the Brazilian soil. The institutional church provided the logistical framework for this religious masking. Local priests served as intelligence officers, using the pulpit to disseminate military orders and cast the act of non-payment to Jewish creditors as a pious duty. This turned the violation of commercial contracts into a sacramental act. The Holy Office of the Inquisition, though technically absent under Dutch rule, was invoked as a looming moral authority to delegitimize the legal standing of the Sephardic lenders. By 1648, the conflict had been successfully transformed from a private equity dispute into a total war of civilizations. The Portuguese used this fervor to sustain a high-casualty siege of Recife, convincing soldiers that their service was a path to spiritual salvation rather than a mechanism for protecting the assets of the planter class. In this environment, the religious dividend of the Dutch era was inverted. The very visible presence of the Kahal Zur Israel synagogue became the primary propaganda tool used to justify the systematic confiscation of Jewish property. By 1648, the Dutch West India Company's territorial monopoly faced a terminal military crisis at the battles of Guararapes. These engagements represented a fundamental failure of European conventional infantry tactics when confronted with a terrain-optimized War of Divine Liberty. The Dutch commander, Sigismund van Schoppe, deployed a force of 5,000 professional mercenaries, relying on the rigid, linear pike and musket formations that had dominated the 30 Years' War. However, the Portuguese-Brazilian alliance, a multi-ethnic force of Luso-Brazilian planters, indigenous Tupi archers, and Black Henriques regiments, utilized the uneven topography of the Guararapes Hills to negate the Dutch numerical and technical advantages. The tactical turning point was the Portuguese use of infantaria de selva techniques, short-range ambushes that forced the Dutch into close-quarters combat where their long pikes became liabilities. In two separate battles between 1648 and 1649, the WEC Land Army suffered over 1,500 casualties, a loss of nearly 30% of its total operational manpower in the region. This was a catastrophic blow to the company's mercenary model. Unlike the local militias who were fighting for land and debt erasure, the Dutch soldiers were high-cost contract employees whose morale plummeted as quarterly pay arrears mounted. For the Sephardic financiers in Recife, the defeat at Guararapes signaled the end of the colony's defensibility. The loss of the hills allowed the Portuguese to tighten a land-based blockade, severing the final supply lines between the city and the few remaining functional sugar mills. The Dutch military, once the premier war machine of the Atlantic, was now physically confined to the island of Antonio Vaz. This shift from offensive expansion to desperate urban survival effectively zeroed out the projected value of the WIC's Brazilian shares, as the market realized that the company no longer possessed the terrestrial force required to protect its industrial assets. By 1650, the structural collapse of Dutch Brazil was precipitated by a shift in naval supremacy that targeted the West India Company's greatest vulnerability: its absolute dependence on the Amsterdam-Recife supply chain. While the WEC had dominated the 1630s with its private equity armada, The Portuguese Restoration had successfully rebuilt a state-funded navy, the Companhia Geral do Comércio do Brasil. This new maritime force moved beyond coastal skirmishes to implement a total strategic blockade, positioning heavy galleons at the Atlantic choke points to intercept the high-value sugar convoys and the vital inbound shipments of European grain, gunpowder, and mercenary reinforcements. This blockade functioned as a fiscal tourniquet. Because the WAC had transitioned the colony into a specialized monoculture economy, Recife lacked the internal agricultural capacity to feed its 8,000 inhabitants. As Portuguese privateers and naval squadrons systematically captured Dutch merchantmen, the just-in-time logistics model of the Amsterdam financiers failed. The cost of maritime insurance for WAC chartered vessels spiked to prohibitive levels, effectively pricing out the company from its own trade routes. By 1652, the flow of liquid capital and physical resources from the Dutch Republic had slowed to a negligible trickle. For the Sephardic elite, the blockade represented the final breakdown of their vertical integration thesis. They held the urban real estate and the debt ledgers, but they could no longer export the collateral. The hunger and ammunition shortages within the walls of Recife became a terminal operational reality, proving that a corporate colony, no matter how sophisticated its financial architecture, cannot survive the severance of its primary umbilical cord to the metropole. On January 26, 1654, the Dutch West India Company's presence in Brazil formally terminated with the Treaty of Taborda, a document of total capitulation that ended 24 years of corporate rule. The surrender was precipitated by the arrival of a massive Portuguese relief fleet from Lisbon, which successfully integrated with the land-based insurgent forces to tighten the final encirclement of Recife. Under the terms of the treaty, the Portuguese crown granted the remaining Dutch and Jewish residents a strict 90-day ultimatum to liquidate their assets, settle their affairs, and evacuate the territory. This 3-month window represented the final closing of the books for the WIC's Brazilian portfolio, as the once dominant merchant class was forced into a fire sale of their urban real estate and remaining industrial interests. The logistics of this mass exodus were dictated by the necessity of maritime transport. Nearly 150 ships were required to evacuate the 5,000 residents who chose to depart, rather than face the inevitable reintroduction of the Holy Office of the Inquisition. For the Sephardic community, the 90-day grace period was a race against legal and physical expiration. While the treaty guaranteed the safe passage of movable property, it could not protect the intangible value of the millions in uncollected debts owed by the very Portuguese planters, who were now the victors. By April 1654, the last Dutch vessel cleared the harbor of Recife, signaling the total write-off of the $50 billion investment. This departure initiated a major diaspora of Sephardic capital and expertise across the Atlantic. While most returned to Amsterdam, a small contingent of 23 refugees embarked on a voyage that would lead to New Amsterdam, seeding the financial and cultural foundations of what would eventually become New York. The fall of Recife was not just a military defeat. It was the forced redistribution of the world's most advanced colonial know-how into the emerging English and Dutch markets of the North. By May 1654, the departure of the Dutch fleet from Recife signaled the finality of the Great Liquidation, a massive transfer of human and financial capital that effectively deindustrialized the region for the Sephardic elite. This evacuation involved the movement of approximately 5,000 individuals, a demographic shift that saw the most advanced merchant class in the Atlantic Basin abandon their urban real estate and legal claims. Because the 90-day ultimatum precluded the transport of heavy machinery, the fleeing families were forced to watch as their white gold empires, the high-margin refineries and crushing mills, were reabsorbed by the Portuguese crown. The wealth of the colony was essentially unbundled as it moved back into the Atlantic, transitioning from fixed terrestrial assets to mobile, liquid property such as precious stones and silver. The economic reality of the retreat was a catastrophic loss of institutional memory. The WIC's centralized accounting systems and the Sephardic family ledgers were packed into crates, leaving behind a vacuum of commercial expertise that the Luso-Brazilian planters struggled to fill for decades. This was a forced capital flight that saw the concentrated liquidity of the Amsterdam Bourse vanish from the southern hemisphere. As the ships crossed the Atlantic, the focus shifted toward salvage and redistribution. While the Dutch West India Company faced imminent bankruptcy, the Sephardic merchants utilized their surviving networks to pivot toward the Caribbean and the English colonies. This exodus ensured that while the Brazilian venture was a total fiscal write-off, the operational DNA of the sugar monopoly was not lost. The Great Liquidation was the terminal act of the 1630 experiment, proving that while a corporate army could occupy land, it could not indefinitely protect a financial system against a sustained insurgency of its own debtors. In September 1654, the arrival of the French privateer Sainte Catherine in the harbor of New Amsterdam marked a pivotal relocation of Sephardic capital from the southern to the northern hemisphere. On board were 23 Jewish refugees, 4 men, 6 women, and 13 children, who had been intercepted by pirates after fleeing the fall of Recife. On these individuals were the tail risk of the Brazilian collapse, arriving in the Dutch North American outpost not as wealthy financiers, but as penniless legal claimants. Their entry into the colony was immediately contested by Director General Peter Stuyvesant, who sought to expel them to prevent the establishment of a non-Calvinist enclave. This initiated a significant constitutional confrontation between the local colonial administration and the West India Company's directors in Amsterdam. The legal resolution of this conflict was dictated by the religious dividend logic established decades earlier in Brazil. The Sephardic shareholders in Amsterdam, including influential figures like Salvador d'Andrade, petitioned the Heeren 19th to override Stuyvesant's expulsion order. They argued that the Jewish community's investment in the WIC's Atlantic ventures entitled them to residency and trade rights in any company-held territory. In April 1655, the directors issued a formal apostille granting the refugees the right to reside and trade in New Netherland, provided they supported their own poor. This decision effectively exported the Dutch-Brazilian model of religious pluralism to North America. The 23 refugees established the congregation Shereth Israel, creating a high-trust commercial bridge between the emerging markets of New York and the established Sephardic networks of Europe. While the Brazilian Empire had vanished, this small group ensured that the proprietary base the financiers had sought in 1630 was successfully replanted in the soil of the North Atlantic, laying the foundational financial infrastructure for the future global capital. The collapse of Dutch Brazil in 1654 did not result in the destruction of its economic model, but rather its aggressive expansion through the export of a standardized industrial blueprint. As the Sephardic diaspora settled in Barbados, Jamaica, and Saint-Domingue, they brought with them the intellectual property of the Pernambucan experiment, a vertically integrated system of joint stock sugar production. This transfer included the specific engineering specifications for high-capacity vertical roller mills and the advanced hydraulic techniques used in Mauritsstad. By relocating this technology, the refugees effectively transformed the Caribbean from a collection of small-scale tobacco farms into a massive, high-output industrial zone modeled directly on the Dutch West India Company's colonial architecture. This blueprint relied on the same high-interest credit instruments that had functioned as the credit engine in Recife. The Sephardic merchants provided the necessary bridge financing for English and French planters to purchase the expensive equipment and forced labor required for sugar cultivation. This created a new Atlantic reality. While the Portuguese held the land in Brazil, the Dutch-trained financiers held the operating system of the global sugar market. The sugar revolution in Barbados was a direct consequence of this capital flight, as the island's output increased tenfold within a decade of the arrival of the Brazilian expertise. By 1660, the financial structures perfected in Recife, fractional ownership of mills, and the forward selling of harvests became the global standard for colonial extraction. This ensured that the WIC's initial $50 billion gamble, though a territorial failure, achieved a permanent technical victory. The Caribbean became a series of new Brazils, utilizing the same lethal combination of Sephardic capital and Dutch logistics to dominate the European palette for the next 2 centuries. The dissolution of Dutch Brazil in 1654 serves as the ultimate historical case study in the systemic fragility of private equity warfare. Often categorized as the Lehman Brothers of the 17th century, the West India Company proved that even the most sophisticated financial architecture cannot sustain an asset class built entirely on the shifting sands of colonial occupation. By the time of the final capitulation, the WIC's stock had plummeted from its peak speculative value to a terminal junk status, leaving thousands of Dutch and Sephardic investors to absorb the total loss of their principal. This was the first major burst of a global colonial bubble, demonstrating that when the cost of military protection exceeds the marginal utility of the resource, the corporate structure inevitably implodes. The fallout redefined the metrics of Atlantic risk management. The Sephardic dynasties, despite their superior information networks and high-trust credit engines, had learned that territorial vertical integration carried a terminal political risk that maritime trade did not. The loss of Recife forced a fundamental shift in Jewish economic strategy, moving capital away from large-scale land ownership and back toward more liquid cross-border financial services that were less vulnerable to the debtor revolts and scorched earth policies of local insurgencies. Ultimately, the 1630 experiment provided the data for the next century of global finance. It proved that wealth derived from colonial monopolies is never permanent. It is merely a temporary loan from the volatile forces of geography and geopolitics. The ruins of the Mauritsstad Observatory and the abandoned ledgers of the Rua dos Judeus remain as silent evidence that in the high-stakes game of 17th century capital, the owners of the source are always at the mercy of the costs required to defend it. If you found this history interesting, this next video will shock you. Click right here to watch it now.